Today, we're going to peel back the curtain on how corporate empires report their finances. We're diving into something called IFRS 10, which is basically the rule book that makes these huge companies show us everything they're working with. Let's get into it. So think about this for a second. When a massive company like Disney goes and buys another powerhouse like Pixar, how do we get a clear picture of what that new combined beast actually looks like financially? Is it really as simple as just adding two balance sheets together? If you're an investor, this is a super important question.
Well, the short answer is no, it's definitely not that simple. The International Financial Reporting Standards, or IFRS, have a very specific rule book for this. And it all really boils down to one single powerful idea that completely changes how we see these massive corporate groups.
And that big idea is brought to life with this term, consolidated financial statements. The official definition says you present the parent company and all the companies it controls, its subsidiaries, as if they were one single economic machine. It's all about painting the complete family portrait, not just a picture of the parent. Now, this concept isn't exactly new. The first real rules started to form way back in 1989. But the game really changed in 2011 when IFRS 10 came along. It replaced the old rules and focused everything on that one core principle of control. And then, just a year later, they threw in a curveball, a really big exception for a special kind of company, which we'll get to. So, what is this powerful principle I keep mentioning? It's all about one word: control. This single concept is the absolute heart of IFRS 10. It's what determines whether a company gets pulled into those consolidated financial statements or not. And the standard is incredibly specific here. Paragraph 7 tells us that an investor controls another company if, and only if, they meet a very specific three-part test. It's not a suggestion. You have to have all three, no exceptions. So here's that three-part test. First, the investor has to have power. That's the ability to direct the activities that really matter for the other company's profits. Second, they need exposure to variable returns, meaning their own financial results are tied to the performance of that other company. And finally, they must have the ability to use their power to actually influence those returns. It's the combination of all three that creates control. Okay, now this is where it gets really interesting. You might think control just means owning more than half the stock, but IFRS 10 shows us that true power can be much more subtle than that. So on one side, you have your classic majority ownership. If you own more than 50% of the voting shares, control is usually pretty clear-cut. But then there's this other concept called de facto control. This is where an investor can have total control with less than 50% ownership, simply based on their practical ability to call all the shots. Let's just put a number on this to make it real. Imagine an investor owns 48% of a company. That's obviously less than half, right? So the question is, can that 48% stake actually give an investor total absolute control over another company? Well, according to the standard, the answer is a resounding yes. Let me show you how. The standard gives us a great example. Say an investor has that 48% stake. If the other 52% of shares are owned by thousands of different people and none of them hold more than like 1%, that 48% block is dominant. If all those little shareholders aren't organized, the 48% owner has the practical ability to win any vote they want and basically run the company on their own. That's de facto control in a nutshell. So you're probably thinking this principle of control is a universal, unbreakable rule, right? Well, not quite. The standard actually carves out a very specific and very important exception. Which leads to a pretty fascinating question. If a parent company clearly controls a subsidiary, does it always have to consolidate it? And surprisingly, the answer is no. And the reason is this special class of company called an investment entity. The easiest way to think about this is a venture capital firm or a mutual fund. Their whole business isn't to operate the companies they invest in, it's simply to make money from those investments, either through price increases or from income like dividends. Now, to qualify for this special treatment, an entity has to meet three super strict criteria. First, it has to get funds from investors for the specific purpose of investment management. Second, its one and only business goal must be to invest for financial returns. And finally, it has to measure its investments based on their current market price, or what's called fair value. So what does this all mean in practice? Well, instead of combining all the detailed financials, An investment entity just reports its subsidiaries as investments at their current market price. And the logic here is that for a company whose entire job is buying and selling investments, knowing the current market value of those assets is way more useful to an investor than seeing the day-to-day operations of every single company it owns.
Okay, so we've gone through the core idea of control, the tricky details of de facto control, and even the big exception to the rule. But let's just pull all the way back and ask the most important question. Why does any of this even matter?
It all really comes down to three massive impacts. First is transparency. It gives investors a true and complete picture of a whole corporate family's financial health. Second, it creates accountability. It stops companies from hiding massive debts or risky ventures inside some subsidiary that nobody ever sees. And finally, it gives us comparability, which means we can actually compare these global giants on a level playing field. And that leaves us with one final thought to chew on. Just imagine for a second a world without this rule. How could we ever really know the true size of a company's debt, or the full scope of its global operations, or the real risks it's taking? Without consolidation, the complex inner workings of these corporate empires would be almost completely hidden in the dark.